Welcome to the Trading Bell Show. Thank you so much for your valued company. My name is Maina Shege. So this week, we delve into the insurance sector, speaking to the MD Kenya Re, that's Jadiah Mwarania, and he's going to help us understand how is the sector navigating through this particular times. But first, let's take a look at his profile.
Mr. Jadiah Mwarania is the Managing Director of the Kenya Reinsurance Corporation Limited. He has worked with the corporation for over 25 years and was previously the General Manager, Reinsurance Operations and Acting Managing Director. He holds a Bachelor of Commerce and Master of Business Administration from the University of Nairobi. He is a Fellow of the Chartered Insurance Institute of London and the Insurance Institute of Kenya. He is currently pursuing a PhD in Strategic Management at the University of Nairobi. Mr. Mwarania is a chartered insurer of the Insurance Institute of London, the highest and most prestigious level of professional achievement with the institute, and a Fellow of the Kenya Institute of Management. He is also a member of the Board of Directors of Industrial Development Bank, ZEPRE, and the Chairman Executive Committee of the Association of Kenya Reinsurers. He is a board member of the Insurance Training and Education Trust Board and member of the Finance and Development Board Committee of the College of Insurance of Kenya. Mr. Mwarania is a holder of the Order of Grand Warrior Award.
Many thanks, sir, for joining us, and a really warm welcome to the Trading Bell Show.
Most welcome.
Great, and I would want to really start this with an easy start-off point, because you have been in existence now for 51 years. You celebrated 50 years the other day, and that's quite a generation that has passed since then. And most of them could be watching today and wondering, Kenya Re, maybe they have not seen you, some may have come across you, but would you kindly endear us with your mandate and core purpose as a corporation to Kenyans?
Okay, thank you for the question.
Yeah.
Kenya Reinsurance Corporation, or maybe I should start by defining reinsurance. That's generally.
Okay.
Reinsurance is about, very simply put, an insurance company insuring another insurance company.
Mm-hmm. So
when the insurance companies take the risks from the general public or the insuring public, mm-hmm. they also require reinsurance, which is called ceding back to the reinsurance, mm-hmm. because they are accumulating a lot of liabilities within their books.
Yeah.
So reinsurance is a risk transfer mechanism where an entity, a financial entity called a reinsurer, mm-hmm. actually insures an insurance company. Mm-hmm. Now for Kenya Re, the mandate was formed 50 years ago, like you correctly put it. Yeah. Actually 51, because that was back in 1970. Started doing business in 1971.
Quite some time.
And the core mandates, mm-hmm. for which it was formed, one was to stop the outflow of foreign exchange, mm-hmm. Out of this country into the foreign markets. Mm-hmm. Because what used to happen that time is that insurance companies would have to reinsure largely in London. Okay. That required foreign exchange, so there was an outflow. Mm-hmm. So the government thought, why don't you create a Kenya Re, which will retain this foreign funds here, mm-hmm. or foreign currency here, mm-hmm. by providing that protection from within. Yeah. There was also the aspect of regulating the insurance industry, which now mandate has gone to the IRA, mm-hmm. Since then. Mm-hmm. But there was a mandate of training the insurance market, or the Kenyan economy actually, on insurance business, how it is done and how it is entrenched. And finally, providing reinsurance protection to the insurance companies in Kenya. Okay. And eventually beyond Kenya, mm-hmm. which is the case today.
Wow. Lovely. Speaking of which, in your last sentence, you've talked about even beyond Kenya and all. And the last time you were on the Trading Bell, you spoke about a little bit of some of the venturing that you were doing. And we have seen you, really open up the spaces a bit more. Mm. And I would want you to tell us, how are these subsidiaries doing? Because you had quite, I would call, a robust strategic plan on how you plan to expand.
Yes, we keep a 5-year strategic plan. Yeah. We've just started one, this 2022 up to 2026. Yeah. Before that, we had one from 2017 to 2021. Mm-hmm. And it is in the last strategic plan that we opened up 2 subsidiaries. Okay. The subsidiaries are part of a business model, mm-hmm. that we have adopted. Yeah. We realize now that we operate in the entire of Africa, Middle mm-hmm. East and Asia, mm-hmm. you cannot service all those countries effectively and efficiently from one capital, mm-hmm. which is Nairobi. Mm-hmm. So the idea of a subsidiary is to set a business hub, and that subsidiary will service the hub. Mm-hmm. For that reason, Cote d'Ivoire is servicing the Francophone West Africa markets, especially the CIMA market, mm-hmm. which have a group of 15 countries. Yeah. Then we have the Zambian subsidiary, which is servicing about 9 countries, in mm-hmm. the Southern African market, mm-hmm. and centered in Zambia. And then Uganda was kind of compelled, we were compelled to open there because the market domesticated. And as a result of domesticating, you either set up or you exit the market. Having developed the market for very many years and now being quite vibrant in the market, we didn't think it wise to exit, so we set up the subsidiary. With time, it will not be difficult probably to extend a few other markets to the subsidiary like Rwanda, Burundi, even DRC, again to create another hub for purposes of building, of servicing that market. So subsidiaries is about service delivery closer to the client, especially when it comes to payment of claims.
Wow. I love that. And now that you've spoken about the 2022 moving forward, are we expecting as well some more expansions as well in your new plan?
We keep reviewing. This is a 5-year strategic plan which is subject to annual reviews. We keep on looking at the dynamics in the market. If you look at what I've described, West Africa, South Africa and Uganda, you will see there is no subsidiary of Kenya in the northern part of Africa. So places like Egypt or Sudan are not remote from our minds. We are thinking about it, we do feasibility studies, and when we think is appropriate, we will make a move.
All right. Let's jump into some of the questions that were popping up even as we are gearing up to have this conversation with you. And there are quite some concerns here about, cash equivalents and the return of capital to especially shareholders. Some people are saying, when shall we expect some special dividend or some higher dividend? So I would want you to speak to the shareholders who, would want to really hear on that matter. Where are we? What's the status?
First, to say that there's a dividend payment policy of a corporation, and we've faithfully stuck to it. There's no year in the last almost 10 years that Kenya really didn't pay dividends. We want to keep to it. Of course, for us to be able to pay dividends, we must make profit. So we try to make sure that our operations are as profitable as they can get. And we stick to the policy. Even last year, when many companies actually opted not to pay dividends, we did pay. We've got accumulated quite some funds in our retained earnings. We don't think it wise to distribute it in dividends as a lump sum, because as a business expands and as we grow, which we are growing, we require capital for purposes of running that business. And given the kind of diversity of shareholders of Kenya, it might be difficult to make a capital call because the very high number of the shareholders. So to avoid maybe having to go back to the shareholders and tell you need to pump in more capital for us to do business, we think the retained earning is a good reserve, so to speak, for buffering the capital and for supporting future expansions.
All right.
But of course, it still remains the shareholders' funds. The return on investment and the return on capital, we're trying to keep it well. So we don't think we intend to starve the shareholders of any dividends in 1 year, including this year.
Fair enough. So, the last 2 years now and going has been quite unprecedented, if I may use that word, because of the Covid-19 that we have seen. And your industry definitely was not spared in a way. And I know a lot of your clients as well have had a big share of it. Of course, from the pressure as well coming from the people who actually take up insurances and all that. What we saw in industries, a lot of layoffs and all that. I don't know how you are faring on and how you are navigating through this particular pandemic. What's your comments on that?
The comment is that, the pandemic has made the operating environment quite difficult in different aspects of the business. The most direct is if you look at the claim side, a lot of especially on the life side of things, even on the medical class of business, we have seen an increase in claims, which is expected, especially emanating from the case of medical coming from hospitalizations. But a lot of other classes of business were affected. Traveling almost came to a standstill. That means travel insurance was adversely affected. Hospitality was hit quite hard. So what we saw was also a shrinkage in total volumes of premiums because certain classes were not being as active as it could be. With the layoffs, it means things like workmen compensation classes were also affected. Life insurance, a lot of people are not able to continue paying for their premiums. So again, you had shrinkage in the premiums. Then the other aspect was the difficulty in collecting premiums. Because we saw even regulators saying insurance companies should probably go a bit easy on the insured because of the general hardships in the economy in terms of collecting the premiums.
Yeah.
And so some and to give layoffs in the terms of the premiums. You don't collect it for 3-4 years. Some were asking for discounts. Some were asking for even complete 100% discount on the premium. So there was the aspect of cash flow which was affected, and the amount of that was premiums that were collected.
Yeah.
On the investing side of things, also you saw, including the banks, the interest rates kind of came down.
Yeah.
The vibrancy of the investing environment, including the NSE, came down. The treasury bills interest also came down. So it means the returns on investment were also affected.
Okay.
All these are direct impact on the business, and you see it reflected even in the profits for this year for many companies.
Okay. Well, fair enough. I mean, let's talk about the elephant in the room now, which is matters penetration of insurance in the country. We're still lingering around 3%. I've not seen an improvement yet. I don't know what you are doing, as a corporation to at least expand the scope, because definitely with an expansion of this to Kenyans, it means definitely greater even returns on investments for your underwriters and everybody else under you. So I don't know, what do you have some aspects, especially now that the fact that you mentioned there's a new strategic plan. I believe there's some components of that, but just take us through, are there any expansion, drives to ensure we expand this?
Yes, the issue of penetration of insurance is, I would say, an issue of partnership of all the players in the market.
Okay.
And actually beyond the market to affect the government and the general populace, because low penetration, by the way, at 3%, in Kenya it is still not the lowest in Africa. It's actually one of the highest. The only high one we know is about South Africa for the life, which it touches 14%. The rest of the African countries will be actually below 3%. Kenya is a bit high, but at 3% we can say the entire continent is really kind of very poor penetration.
Very true.
And the reasons are basically two. One is awareness, where it looks like the population is not so aware of the importance of insurance.
Yeah.
And therefore the solution to it becomes create more awareness, education programs, educate the public on the importance of insurance, and the corporates as well, especially the SMEs, the many of them which are not insured. Individuals, the average person will want to go for a third-party motor insurance, even those with vehicles, rather than a comprehensive one. So there's quite a lot of scope improving the scope of training and education of the importance of insurance that would do in terms of entrenching the penetration of insurance. The other major factor is affordability. Okay. A lot of the population is not able to afford insurance, especially life insurance. Many people find it expensive. Even motor, that is why they go for third party, not comprehensive, where the premiums are slightly more. So again, where it is issues of affordability, then these initiatives of government of poverty eradication and efforts of educating people and telling the importance of it, why you may need to sacrifice something for purposes of the sake of having insurance, it really comes in handy. So economic empowerment of the population, government strategies of poverty eradication would go a long way in that. Then the other thing is now, which is more for the industry, is developing products that fit the specific needs of the insuring public. And having educated them on the need, then they also have demands which the industry should match. So use of technology, maybe to reduce the cost, use of technology to improve efficiency in things like payment of claims. All this would make the product more available at probably a cheaper price, and addressing specific needs of the policy rather than of the policyholder or potential policyholders, rather than maybe a blanket product that would go away in entrenching.
There are people who sit down, and some of these products that are offered by the various insurances available, some of them are still unknown to them, and definitely, as you're saying, there's still a lot of more work on education and all that. But there's a question actually I should have asked you before. We went to the penetration, and it was about the menu that is offered definitely by the insurances that we see. Do we see, or do we foresee some expansion in some of these areas? Are there new things that you foresee maybe coming into penetration or coming to be offered that you would want to enlighten us on?
Yes, like I'm saying, the issue about if you look at the product on the market, they started maybe at the colonial days with having been uptaken from the colonial masters who could have been the British for the sake of, in the case of Kenya, and a lot of them have remained fairly traditional products. It's a fire product, it's a an accident class, it is kind of standardized.
Yeah.
And what we are saying is that given the way the market is dynamically changing, given all the technology we have, given all the various demands of various sectors of the population, it is becoming more apparent that we need to develop products specific to the specific customer needs.
Yeah.
If you're, for example, in the technology space, cyber kind of service, the kind of product you need is different from somebody maybe who is giving purely a financial service. So there is need to variegate this product such that you're specifically addressing a sector and as a subsector and an industry, even a specific business.
Okay.
Traditionally, the way it has been done is to include certain coverages or put in some exclusions to just limit the cover or expand the cover. But we think there is need now for more flexibility, make the product more tailor-made, so to speak, to the needs of the business.
Okay.
So the area of technology is quite key.
Okay.
Yeah.
Speaking of that, by the way, the other day when I asked for some my insurance for the car, there's no more riders coming to give me this. So we're seeing a lot of direction going towards paperless. I don't know what Kenya Re is doing to position as well itself with all these changes that are there. Are there things that we are seeing there?
Paperless is the way to go. Kenya Re saw it long before even the pandemic came.
Oh.
Because yes, what we are seeing now is even the policy documents. So the days are gone when you would have to depend on walking into an insurance company to get a physical policy document.
I know.
At least have gotten offloaded into the technology.
Yeah.
You can make your claim on your phone. Take a photo, for example, of an accident which has happened and send a claim to your insurer. They are able to pay you. You are aware that, of course, that the premiums can be collected on things like platforms like M-Pesa.
Right.
So everything is going into the technology.
Yeah.
For us as Kenya Re, when we looked at our business, even before pandemic, we realized that you cannot run it on any other platform other than technology.
Yeah.
So we got specific technologies. For example, we have a software we call 6, which is our insurance management system for life and non-life business. And this system handles the claim side of business as well as the underwriting.
Yeah.
And we find it very prudent. It's we think one of the best there is in the market.
Yeah.
And that is how we manage the insurance business. Wow. Then for our actuarial functions, we've got another one, we call it Profit. It is able to do all aspects of actuarial, like pricing, like reserving, and all the other aspects of actuarial business. So again, it makes actuarial valuations and reserving quite efficient.
Yeah.
We've got Idea, which is for internal auditing. This is a software for data mining and facilitating efficient internal audits. Wow. We've got research tools such as MVivo. We have another one we for actually on real time kind of data. You can see the behavior of the premiums per class of business as well as claims. Wow. How the classes are behaving. Is it making money or losing money? We call it ClickSense. Yeah. So technology is really the platform on which, and going forward, we still think we need to keep embracing this technology. We think now we should even have situations where we interface with our clients, being at the insurance company, where we can get their data in terms of the technical statements, in terms of claim submissions online between ourselves to reduce as much paperwork or paper interactions between ourselves. Not even so much of emails, integration of the systems.
Integration. Wow, you're right. Technology is the way to go. Speaking of which now, this year, we're headed to some heated time, and sometimes the insurance industry is the one that actually gets on the receiving end as well.
Yes.
It's the political season. I don't know what you are doing to position yourself, in a way that will go through the season. And on top of that, I don't know how you foresee the sector being shaken and even the economy in general. What would be your sentiments on this?
The sentiment is that at least since 2007, 2013, 2017, we've seen the effect of political electioneering in the country.
Definitely.
2007 was the worst. in 2013, in 2017, we didn't see as much disruption.
Okay.
But obviously, as political temperatures rise, the political risks also increases. So you expect a bit of heightened political risk, which may mean more uptake of insurance.
Yeah.
We expect also a bit of reduced economic activity, so you may see a bit of slide in the GDP coming down. You may see a bit of inflation coming up. Again, these are expectations. It is very difficult to predict with precision in terms of what will happen. But these are some of the kind of general expectations.
Yeah.
Now, for ourselves as a business, of course, we protected ourselves. We've got political risk insurances on cover for all the properties of the corporation. As you may know, Kenya Re owns the Reinsurance Plaza, Anniversary Towers, and Kenya Re Towers, as well as the Anniversary Towers in Kisumu.
Yeah.
So in terms of the physical infrastructure, the building and the content, they are protected for political violence. There is also, of course, adequate retrocession for whatever insurances we've taken on on those properties, and awareness. We've created awareness, of course, against staff among the staff also.
Okay.
Even how to sense events that could produce loss and maybe injure life.
All right.
So we would think we are fairly prepared. As a market player ourselves, we are giving political coverage to insurance companies who want to reinsure themselves, and it's actually one of the latest products, because we got it from 2007 or there is when we started giving it to the market, and we're giving it across Africa. So we also think it's a source of income for the corporation, and as long as the risk is properly diversified, it shouldn't be anything to worry us.
You're right.
Yeah.
Goodness, we are at the tail end of the interview, but I just have to bring this here. You know, the other day I saw, of course, your market players as well. You know, some of them saying we are not doing well, we are not doing very well, and I think they were trying to do a push so that at least they can increase a little bit of the income. I think the whole story was challenged, but I don't know whether you're allowed to make a comment on that, or whether it's something that is still in the books. I don't know, what's your comment on that? Did you notice that?
We noticed it, and it is still an issue which is ongoing. I think it would be good not to comment on it, at least publicly, but yes, these are normal market dynamics.
Okay.
What we normally do is that when the different stakeholders are affected in different ways, so what we will do is, because we have platforms like the Association of Kenya Reinsurers, the Association of the Association of Kenya Insurers, in these forums, with the help of the regulators also, we sit down and thrash out the issues.
Okay.
The whole idea is really to give the most quality service to the insuring public. And sometimes that service may not be as quality as can be if it is not properly priced. Which is basically the issue, the gist of the issue that you're raising.
Okay.
What was coming out, or what is coming out from many market players, is we need products in the market that are properly priced. It is the only way you can ensure sustainability of the industry. If the premium rates are not economical, then the industry is not sustainable. It's a matter of time before some players start falling short, and that doesn't help anybody. If any insurance company folds up like they did in the past, the people who suffer is the policyholders, who are citizens of the country. And that is a concern to a regulator, for example. It's a concern to all of us in the industry. So the whole idea of those premium rates and adjustment was, why don't we determine the correct economic but affordable or premium rate that is not punitive to the insuring public, but is also adequate to make the insurance companies self-sustaining in terms of their operations, and also making profits for their shareholders, so that we have a sustainable and an increasingly growing and strong industry. We've seen this in South Africa, maybe is a place one could look at, and Europe, where you have maybe not as many players, but very strong ones. And when they are that very strong, it means that it's difficult to have any policyholder coming in their claims which are not being paid because of lack of resources. These resources come from the premium rates. So that is a whole conversation. It's an ongoing conversation.
I can see it's an ongoing one, definitely. Of course, I can tell you from a selfish point of view, I hope they don't hit the 50. They can start maybe with 10, 20, slowly by slowly. I'm just saying. Wow, there you have it. And just before we end, I would like to end on this positive note because there are people who are watching and saying insurance, as we have said, 3% is still low and we are still struggling to up on that. I'd like you to paint a picture of confidence, you know, to the people who are watching, who are looking at you as the MD Kenya Re, and tell them why. Maybe paint a picture to them why it is important for you to always, you know, feel that you're taking up some of these products because of the safety that they have. How would you paint that picture of confidence to them? Please go ahead.
It's very easy. I would say look at the first world or the developed world. Look at Europe. Look at America. Look at Australia.
Yeah.
In fact, it's only in the emerging world that, like I was saying about insurance, maybe the levels of awareness are not as high as they could be in terms of the need and the importance of insurance. Maybe affordability also comes in. But if you went to Europe or America or US, insurance is a way of life.
It's a way of life.
When you're budgeting for your household, the way you budget for school fees, for rent, for amenities like electricity and everything, insurance is right in there. In fact, it's the most important. And it is so important that you don't realize the value of the valuables in your house until it is engulfed in a fire and you've lost everything without insurance. You don't realize the value of insurance unless you had an accident and you had a car written off which was not properly insured, and then you realize you're actually losing value. So insurance is a mechanism for preserving value. Working on the law of large numbers, where all of us pay a premium, a small proportion of what we are insured for, but we make a pool, a large pool enough to pay the few unfortunate of us who get losses, because out of statistics it's known that there's only a few who get losses. Those few will be compensated fully, and then there will also be, of course, profits for the operators of the scheme. So to that extent, because of that need to protect value, to preserve value, and for life insurance also, posts, for example, death. If you have something like education policy, your kids can still go to school. It's like you already done the savings element, and the saving element as well as the protection elements are in there. So there's so much value in there, and you don't realize it until you lose. So really the encouragement to the insuring public is to know that insurance is as good as any other investment. It's like buying a piece of land, probably better than buying a piece of land or putting up a building, because when it is your fallback plan. Especially like injuries, for example. To give another example, if you had an accident and you've got physically, you're maimed. Again, you've got a fallback because you had that personal accident, for example, or a group personal accident or life policy. So it is a way to go. It is something we need to embrace as a nation, to preserve the national economy, to preserve private entities' economy, and to provide even individual finances.
Wow, I know you could go on and on and on.
True.
Definitely being a member and a key leader in this particular sector. Thank you so much for your time, sir.
Most welcome.
All right. There you have it. And we are speaking about insurance, as he says it, don't wait until it's too late. If you can take up a product now, the better, so that you don't have to wait until some unfortunate event happens. That is Jadiah Mwarania, the MD Kenya Re, and he has put it as it is. Up next is the market.